Hi guys, welcome back to the channel. My name is Dave, and today we're going to be talking with Troy Cates from NEOS Investments. This is the same group that brought us SPYI and QQQI, which we've talked about before. I'll link those videos up above, but today it's all about their new ETF, IWMI, and this is a new option-based, income-oriented ETF, but this time based on the Russell 2000. So if you like these type of products and you're looking for diversification, this might be a good one for you. And this is something that I think is very important for myself. So I'm always looking for ways to diversify my own portfolio. So if that is what you're looking for, please stick around. Whoop. Welcome back to the channel, Troy. Really appreciate you coming on. So today's topic is going to be IWMI, all about this new ETF that you just released, and a little bit about the product itself and the makeup and the option strategy. But before we jump into that, I do want to talk about the VIX spike heard around the world from the Japan carry trade. Just kind of get your perspective from somebody that does a lot with options and these option-based products. So we had a very quick decline in the S&P and a very quick recovery. So I'm curious, is there anything from an actively managed fund perspective that can take advantage of that type of situation? And for the products that you do have out currently, because we've talked about SPYI, QQQI, and now today IWMI, is there anything there as far as the options that were in place that needed to be repositioned during that quick decline, or did everything kind of bridge across that time frame?
No, well, first of all, thanks for having me back. And yes, it was an interesting time because you don't see spikes in volatility like that too often. The last one that kind of spiked above that 60 level, I believe, was during COVID. So it doesn't happen that often. And when it does, it can seem scary because, yes, like you said, the equity markets are selling off. You have this really deep sell-off from what was going on overseas. And then suddenly volatility spikes, and what goes on during that time frame in a product like ours. Just to kind of backtrack a little, if you remember, all of our option-based strategies, whether it's SPYI, QQQI, any of the fixed incomes ones like BNDI, CSHI, and now IWMI, they're all rules-based and systematic on how we trade them, when we trade them, and what the portfolios look like. So we had just rolled SPYI, QQQI towards the end of July. And volatility was a little higher than it was the previous month, but of course it was not sitting up at 60 where we saw it that one day in early August. But how it works is as we're getting flows in, we're still adding to those option positions. So if we're getting flows in on a day like that, whether it was the day before, that day or the day after, as volatility starts to come in, when the equity market starts to rebound, we're adding to those option positions at a much higher volatility level, bringing in more premium, even though they're further away from the money because the market has sold off. So it was an interesting time for at least the equity products. And then on the fixed income ones, on BNDI, CSHI, we roll those on a weekly basis. So those funds really were able to kind of harness that extra volatility in the premium they brought in during that week and even the next week, because it didn't drop off as quickly as you might have thought, but it did pair off over the next few days. So I was able to kind of capture that volatility and bring in a little bit more premium for those funds. But as far as the actual short calls in SPYI, QQQI, IWMI, they were all on right before that one big spike that day, but we were able to capture some of that extra volatility as we were adding to positions.
And you can get that whipsaw effect from an options trader's perspective when if you get too aggressive, it can really work against you. So interesting to hear that. So now let's talk about IWMI. This is our Russell 2000 product from NEOS. But I think we start out with the meat, which is just the IWM with no I added to the end, to understand a little bit about the difference with this product versus the other ones. So I guess let's just talk about Russell 2000. What is it, and why did you decide to build a product around the Russell 2000 in the first place?
Sure. So when you're thinking about your asset allocation and what we look at NEOS, we started with 3 funds when we launched our initial suite of funds. So we thought about, from an equity standpoint, we'll start there. SPYI was the broadest, the S&P 500. It's where a lot of people go to invest. And we wanted to start there with the option strategy on top of it to kind of get you into that equity portion of your portfolio. And as we're trying to slice up the asset allocation pie a little more, we started next with QQQI for the NASDAQ 100, and we also wanted to get to the small caps. So the Russell 2000 is a small cap index. It's the smallest 2,000 companies based out of the Russell 3000 index. And you take that group of these smaller companies, and it's obviously a large diversification of 2,000 different companies within the index. And it's really where you can get exposure to the small cap space. And we wanted to have that small cap exposure because it should be part of, it could be part of your asset allocation as you're looking to diversify your portfolio in general. And the small cap space also, given what may or may not go on this fall with the Fed potentially starting to cut rates, looking out in September, November, December, you have to think about, do you want to be in this small cap space? And traditionally, these companies tend to do better when rates are lower because a lot of them rely on financing to grow their businesses. So that's where that kind of trade moves from maybe the growth or larger cap names to the small cap names as you see rates being cut.
Yeah, I mean, if you look back at a 10-year chart of the Russell and you compare it to the NASDAQ and the S&P 500, it's not going to be very impressive. So from an investor standpoint, if that's all you're looking at, you're probably not going to want to be investing in the Russell 2000. But the big hook there is that with declining interest rates, there's a lot more potential for the Russell to react in a positive way. So rate cuts look like they're on the horizon, and it does add a ton of diversification. I know for me personally, that's a key part of my investment strategy. So a product like this fits in really well. So if you're into these covered call ETFs, this is almost a must for me. The only other product that I can think of is RYLD that kind of falls into the same arena, but I like your strategy better. So for me, this makes more sense. Are there any other products that you can think of that kind of cover this area as far as with an option overlay?
With the option overlay, there may be some newer ones coming out, but as far as we're concerned, we look at it, IWMI, we wanted to bring in a similar option overlay that we do in SPYI and QQQI. So just to break it down a little, we're long a representation of the Russell 2000. We're not looking to buy all 2,000 names at this point as we're growing the ETF. So we buy an ETF to have the underlying exposure. And then what we're doing, we're using Russell 2000 index options. So we're still getting that tax efficiency from the index options that we've talked about before, those 1256 contracts that kind of break it down to 60% long-term, 40% short-term cap gains, no matter the holding period. And we're using the call side of the option chain. So we're selling those calls on a monthly basis out of the money to bring in premium to put out as a distribution. Now, if you think about the Russell 2000 has usually more volatility than not only the S&P 500, but also the NASDAQ 100. So you could bring in a lot of premium even when we're writing out of the money. So to give you an example, when we rolled this past month, the calls were anywhere from 1.5% to upwards of 4.5% out of the money from the strike price from where spot was when we rolled. So you're writing really far out of the money, but we brought in a lot more premium. And I know we've talked about it before, but a big portion of how our rules-based strategy works is looking at volatility levels and not only taking that into account of how far out of the money, but how much notional to overlay in the portfolio. So I believe when we rolled it, it was just about 70% coverage of the portfolio. So you had a good 30% of the portfolio that could move higher without any short calls on top of it. So you'll see that with the Russell, you'll have these big swings. You'll have these big months where you'll have an up 10% month, and then maybe it pulls back a little, and then maybe it has a big month again. So we want to make sure on those bigger months, not only are we writing out of the money, we're also capturing a lot of that upside by not overlaying too much of the notional. But at the same time, it is an income product. We want to make sure we have a good distribution. So that's where we bring in enough premium with that overlay using the Russell 2000 index calls.
And what is your target distribution rate for this one? So That surprises me a little bit. The volatility is actually greater versus your QQQI product. So what kind of distribution are you guys hoping to do this? Because with all your products, one thing that you do is you hold that distribution pretty steady overall, going month to month.
Yeah, so the distribution that we are targeting is in that, call it 13 to 15% range. We did have a nicer distribution this past month because of that added volatility that we discussed. So the distribution was more towards the higher end of the range, but it will vary slightly depending on where volatility is and stuff. But yes, we do aim to kind of have as consistent as we can distributions. And you'll notice if you look, SPYI and QQQI were a little higher as well this past month when we put the distribution out. But again, they all have ranges that we're trying to fall into. But for the Russell, you think in this 12 to 15% range.
I'm sure people will be very excited to hear that. And that's a very big number to be distributing. So, and I imagine this will follow the same rules as far as you mentioned strike price, time till expiration. So I think it was about 6 weeks out, right? I mean, you roll when they're still with about 2 weeks to go, and you roll them back out to about 6 weeks. Is that accurate?
Yes, exactly. So yeah, we're rolling on a monthly basis, but that duration is about 6 to 7 weeks. We're going out to that next third Friday, which is the option expiration for index options, the regular expiration.
Okay. And you're layering these in too. I looked at what you currently have. Their expirations for September 20th. Mm-hmm. Strikes are 2365 and 2420. RTY or RUT, you should say, is currently sits around 2203. So right now, everything looks pretty good for this month as far as those options that are sold. Again, you're probably going to look at the very end of this month to roll out to the October.
Correct. Okay. Yes. So we'll be rolling at the end of August, and we'll go out to that third Friday in October and use that as the expiry for the strike prices we pick.
And then as far as return of capital, we always have to mention that if there is return of capital from losses on the options, that's when we'll actually see that return of capital come out through the fund at some point at the end of the year.
Yeah. So return of capital, again, that's something we look to, it's a tax designation. I know we've gone over it before, but I think it's important to note a lot of people associate it with getting your money back. And in some cases you might, but we're looking not to return principal. We're looking to use it as a tax designation to say, hey, if we have losses in the option portfolio, like you were saying, that can carry forward but offset some gains elsewhere while still making a distribution, we look to make sure we could get as much as possible classified as return of capital in, so when you get that 1099 at the end of the year, you might have a portion of return of capital, long-term cap gains, short-term ordinary income, and so forth, and QDI. And it kind of all breaks down into seeing what you owe. Because again, while we want to have a nice gross distribution on a monthly basis, on an annualized basis, we want that net after-tax distribution to be as close to the gross as possible.
You're using the Vanguard ETF VTWO instead of IWM, which is the iShares version, which is probably the most popular or well-known, but VTWO does have a lower expense ratio, so makes sense to me. And this really probably saves you a lot of time. So that 0.1% or 10 basis point expense ratio of VTWO is not passed through to me. You're offsetting that. That's basically your cost to manage this fund in lieu of managing 2,000 small cap funds every time somebody buys or sells. Is that pretty accurate?
That's exactly why. I think when you're at, the fund has grown a lot, but it's still not up to a space where every time you get a creation in, where you could divide that amongst the 2,000 names. So it makes more sense at this, specifically at this point in the IWMI's growth, to hold an ETF. And yes, that 10 basis points, it's not passed on to the client. So you're still paying the total expense ratio for our product of 68 basis points. So that's important to note. But yes, managing 2,000 underlying small cap names can be cumbersome, but it's also there's there can be a cash drag if you can't invest in all 2,000 names, depending on how much money you have coming into the fund.
So the expense ratio for all three of these products is 0.68%. So you've kept that level. As far as who you see buying this fund, I guess I can say I'll probably be buying this fund. If I'm gonna own SPYI, QQQI, I would probably be adding this as well. I like the concept of putting all of these together into one big soup bowl is my analogy. Mixing a lot of these different strategies together, different indexes, more diversification is better. That's my view. But who do you see kind of buying this fund?
So yeah, we're looking at, when we talk to clients, whether it's an advisor or individual, it seems to be very similar to what you were saying. They like the income. They want to diversify a little more so they can not be in all the same types of underlying stocks. A lot of people, when you break down what ETFs or mutual funds or maybe stocks you own, sometimes you own a lot of the same stuff. So it's nice to diversify that out across a few different indexes, get income from a few different avenues. And you might see as rates get cut, maybe the small caps perform a little better. So that portion of your portfolio might perform a little better while still bringing in that income that you're looking for. So when it comes down to it, a lot of people, very similar to what you're saying, they're still looking for income. They like the different indexes, and they want a little more diversification in their portfolio.
Finally, is there anything new going on at NEOS? You guys working on anything new these days?
Yeah, thank you for the question. It's been, we have our 5 ETFs out right now, and we've seen a great growth in them. The AUM has really grown across the board. We're really excited about that. We have 2 funds that we're in the middle of proxying over to NEOS. One is an ETF that's out there now, managed by another manager. And when that comes over, we could definitely hop on and I could walk you through what's going on in that product and the option strategy there. We have another one that is a mutual fund, more on the high yield side, so to add to our fixed income side. And we're going to convert that mutual fund to an ETF and add an option overlay to that for additional income and pay that income out monthly like the other funds. So that'll kind of start to grow our products a little more. And then we do have a couple more that we're going to put in registration soon, so we can get more funds out by the end of the year. So we're looking to grow, but strategically bring things out that make sense where we see there's a demand for the product. We're not trying to bring out a lot of products at once. We want to bring things out that make sense to us.
Makes sense to me. All right. Well, I appreciate you coming on, explaining IWMI. Is there anything that I'm missing here?
Listen, I think you always do a great analysis of how these products work. And I think IWMI is just complementing what we're doing in the 2 other funds on the equity side, QQQI and SPYI. It's just adding in that small cap exposure that certain people are looking for and still bringing in nice monthly income with it.
Well, I appreciate your time. Thanks for coming on. And I'm sure we'll see you in the near future.
Thanks for having me.
So let me know what you think about IWMI down below. Is this the type of product that you're looking for? Do you want to diversify into the Russell 2000, or will you ignore it altogether? Now, I'm more of a growth investor than I am an income investor at this point in my life, but I continue to buy a few of these products and mix them together. And my concept here has always been kind of the soup bowl method. So diversification for me with this portion of my portfolio is extremely important. So like I said, this is kind of a must for me, but I'd love to hear from you and what you think about this. So if you've got questions on it or anything else or a comment, leave it down below. And if you like this type of thing, like and subscribe. But as I mentioned, if I was to really build a portfolio around income, I wouldn't put it all in the S&P 500. I wouldn't put it all in the NASDAQ. I wouldn't put it all in the Russell. I would mix it all together into a big soup bowl and try to get an overall return out of these products. So they're going to perform differently at different times. And I think that's the best approach if I was going to build a portfolio out of these types of option-based income ETFs. Enough said. So any questions, ask down below, like and subscribe, and we'll see you next time. Have a great night. Whoop.